Hello and welcome back to our weekly market recap. I'm by myself again this week. Let's get into it. So this past week we saw the market down 1.48%. Year to date we're still up 0.32%, but over this past week we did see a lot of the gains that we saw in the first week of the trading year given back. So what ultimately had that effect? What we saw this week was a lot of negative economic foundational data. So we had the continuing jobless claims as well as the new jobless claims. We also had retail sales come out on Friday, and we did get an update from President-elect Biden on his economic plan and the next round of stimulus. So those three together had different effects on the market. So first, let's talk about the initial jobless claims that we saw. And this was some of the worst economic news that we saw. So we were expecting 800,000 new jobless claims, and instead we got 965,000. Now, that was up from last week, which was 784,000. So what we've seen is a consistent, steady rise in initial jobless claims. Ultimately, that's bad news for the economy, and the stock market does not really like that. Now, the other bit of information that is important to look at are the continuing jobless claims. So the initial are the ones that are brand new this week. The continuing are the ones that have kept going. And now the new ones this week are reported as of January 9th, and then the continuing jobless claims are of January 2nd. And as of January 2nd, we still had 5.27 million people continuing in jobless claims. So that's a pretty large number. But something that is interesting, when we look back at November and the current job openings, we have $6.5 million we have 6.5 million job openings. So what does that mean? Really what that's telling us is that we have a lot of job openings, but the talent and the training isn't currently there for the people who don't have a job right now. So the biggest thing affecting the market and the economy is that the jobs that are open, the people who are looking for those jobs aren't necessarily have the right credentials or talent to be filling those jobs. So that's definitely something interesting that we want to continue to watch and monitor as we go forward. Now, the other bad piece of economic data that we got this week was really around retail sales. So that came out on Friday, and we were expecting retail sales to fall, but just a little bit, around 0.1%. Instead, we saw them fall all the way 0.7%, and this is in December. And for anyone who's in retail or knows about retail, December is one of the biggest months in general for retail. Sometimes the whole year is made in December. So the fact that we saw it fall off that much in December is a little worrisome, and one of the other reasons why we saw a continued sell-off for this week. Now, the last big piece of data that was moving the market this week was really surrounding Biden's new $1.9 trillion plan. Now, as we've all known for a few weeks, the $2,000 stimulus checks, those are absolutely going to be in there, as well as help for state and local government. So that was something that was new and definitely a Democratic agenda that was added to. Another thing that was $415 billion to help fight the coronavirus, and another $440 billion for small businesses. So really one of the biggest things that came out from the plan last night or 2 nights ago was this commitment to the vaccine rollout. President-elect Biden said that so far it's been well underproduced and well under disseminated, these vaccines, and his goal is to have 100 million vaccines in the first 100 days of office. Now, this is a massive difference between the last administration and also a huge undertaking. The logistics that are going to have to go into 100 million doses in the first 100 days. So it'd be really interesting to see, with the federal government behind it, instead taking that over instead of just leaving it up to the states, what can happen. Ultimately, as we've said all along, as the virus is really the most important part that's affecting the markets right now. If we can get this virus under control, there's a lot of evidence that the economy is still running really strong, relatively strong, and the market will benefit from that. Now, the only other thing that we are looking at that is a little bit worrisome is in the past month, we have seen a run up in bond rates, bond yields. So what does that mean? Basically, the 10-year yield has jumped over 1%. Now, in the past, since August of last year, it's almost doubled. So what does that mean? With interest so low, with these rates so low on bonds, it's really kept people in the stock market. There's nowhere else to put your money. And one of the interesting things that we're looking at more, and if the trend continues, if we continue to see these interest rates of bonds go up, at what point are people going to have a max exodus out of the stock market? Now, that's not something that we are predicting right now or think is really on the table, but it is something that we're looking at to see if this trend continues. Because if it does, we could see people taking a lot of their money, a lot of the run up that they've seen in the market, and go and put it into fixed income once the rates get a little bit higher. Now, we do still think that having a diversified portfolio is absolutely the way to go, and we will be rebalancing very soon. But it is something that we're looking at. And if we did see interest rates continue to rise at this rate, it wouldn't be surprising to see a pullback or maybe even a correction in the market in the next coming months if this trend continues. Now, that is obviously a big if, but it is something that we're looking at and actively considering. Well, anyways, I appreciate you guys so much for spending time with me. And as we always say, we're here to support you. Your money's here to support you. I'll see you again next week.